All right. Them in. Hello, good morning, good morning.
Good morning.
Good
Good
morning.
morning.
Good morning.
I guess for some folks it's afternoon already.
Yep.
That's right. We got a few yips. We'll wait. We'll just wait one more minute, let some folks in. Maddie, I've made you co-host. You can help out.
Thank
Grant, you are as well, just in case.
Awesome. Thank you.
Feel free to turn your camera on. We love to see some of your faces. Then it doesn't seem like Grant and I are here all by ourselves. But we understand if people prefer to stay off camera, that's fine as well. And Maddie's here from our team. Maddie Millen. And Grant, can you see my screen?
I can, yeah.
Perfect. Okay. Well, for essence of time, we are going to get started and just jump right in. So, thank you for joining us, everyone. I know we'll have some more trickling in as we jump in here, but we'll just get going anyway. Today we are chatting about private credit and angel investors as an alternative to SBA, and we are lucky to have Grant Ferguson with Jumpstart Finance here with us today. And I'll introduce Grant a bit more in a moment, but just a little bit about Village Wellth. If you are new to our speaker series, my name's Liz McCrae. I'm a co-founder and the president of Village Wellth, and this is our Friday speaker series. We also do open office hours within our membership, but these sessions, we thought it would be much more fun to introduce some folks and bring them in. So we are a deal management platform that was built for buyers. So a lot of first-time searchers use us, or people looking to accelerate their search process for a business to buy. Our deal management platform gives users a customizable dashboard for them to manage all of their activity. We have a built-in marketplace system with over 50,000 listings with daily updates, and our AI analysis tools provide deal structuring and financing calculators embed, as well as SWOT analysis and all sorts of fun tools and features in app. So if you haven't yet discovered that, we invite you to take us for a test ride. If you are a partner or an advisor in the ecosystem, we partner with ETA accelerators, incubators, ETA communities, lenders, investors, brokers, and M&A advisors. So if you are in any of those categories and would like to reach out, we welcome you to connect with us. If anyone is new and hasn't tested out Village Wellth, we do have a 2-week free trial with our monthly subscription, and that includes full marketplace access, notifications of new deals, weekly open office hours, and then you get full access to the deal management and analysis software for you to manage your search. Little bit of housekeeping. Feel free to introduce yourself in the chat. Let us know where you're from. If you're actively searching, if you're an advisor, please feel free to let us know what perspective you're coming from today. I'm going to briefly introduce Grant, and then he has a short presentation. Today is discussion based. That's why we run our sessions as meetings. So we'd love to hear from you. Feel free to ask your questions as we go. Don't hold back. I've heard Grant speak before, and he can hold his own very well. So we first ran into each other. I think it was 2021, Grant. I remember you more than you would remember me. I think you were presenting at an IBBA conference, and I think it was the first one that they had after COVID. Everyone was still kind of masked up. And I was really impressed with how open you were with sharing your knowledge, and you were a full open book in your presentation, and that's where we first connected. So happy to have you here today. So, a little bit about Grant. Grant is the CEO and managing partner of Jumpstart Finance and managing partner of Biz Buy Angels, which we're going to hear more about today. He has over 30 years of experience in financial services with a focus on private credit, specialty lending, and building scalable lending platforms. Grant is also an entrepreneur who went through ETA and is an operator. In 2020, he acquired a lending business that would later become Jumpstart Finance, giving him firsthand experience navigating the challenges entrepreneurs face when acquiring and financing small businesses. That experience informs his focus on developing practical, scalable capital solutions for the ETA market. He has held senior leadership roles in both bank and non-bank lending environments, including executive experience at JP Morgan Chase, and has worked extensively on credit strategy, underwriting, and institutional capital partnerships. Grant holds a finance degree from the University of Maryland and an MBA from Bradford University. So welcome, Grant. Thank you so much for being here. Is there any fun, interesting fact that you'd like us to know about that's not on your formal profile biography?
I really appreciate the introduction, Liz. And that's a very flattering photo of me, obviously. And B, for the record, I remember you as well as you remember me. So appreciate the call out. That was a good session. Yeah, the only thing I didn't mention is that I am a musician as well, and I've released
Oh,
7 albums, and
what?
they're all available on Spotify, so if we could go ahead and put the soundtrack on during the session, I'll get, I think, 2.3 cents at the end of it, so, but no, I
We'll put that in
appreciate,
the show notes
yeah,
when we
exactly. I
send out the
appreciate
recording.
yeah, for sure, the warm welcome, and I'm really thrilled to be here for I think, as Liz says, a collaborative and lively discussion, as opposed to a transmit only kind of a session. So with that, I can dive in if you are ready for me to do that.
Let's do it.
All right. So first of all, for all the Canadians or the folks that actually speak and spell English properly, apologies for the spelling of gray. I guess we could have used silver tsunami instead, but of course, everybody here, I'm sure, being embedded in the ETA space, is well aware of the sort of demographic time bomb that's going off. So we can skip to the next slide. My real premise today is that the wave is here, but I think we're going to need a bigger boat when it comes to finance. And the bottom line is that the go-to, and I'm not here to say anything critical or negative about SBA lending, but the go-to programs for business transitions just aren't going to be big enough, to handle this coming wave that's already upon us. And so I'm excited to see, and we're involved in it, and want to have a discussion today about some of the kind of emerging credit landscape and new credit ecosystem that is developing in order to finance this wave that's upon us. So I think, as everybody knows, we all hear the 10 million businesses and 10 trillion in enterprise value. McKinsey did some work recently that I think pares it down a little bit more accurately, kind of excluding solo entrepreneurs and looking at employer businesses to, still about 6 million businesses and about $5 trillion in enterprise value. So there's a tremendous amount of business worth that's going to be changing hands here. So if you don't mind the next slide, Liz.
Oops.
And we can start over too if you want. I mean, that's fine. The drivers of the wave, obviously, is you got 55 plus controlling 50% of these businesses. Many businesses lack succession plans, as we know. Many of them will close. Some may transfer to families, so there might be family succession. But one of the biggest things that I think is really interesting is just the emergence of and the legitimacy of being an entrepreneur through acquisition. And as I've heard it said, the business acquisition is the new startup, right? We're not forgetting the days of the dot-com boom. I'm old enough to remember them anyway. And there's still something very exciting about startups, and there's something exciting about driving and being involved in the next unicorn, right? But there's also something very exciting about getting your money back if you're in if you're an investor, and growing something and finding a business that has all the right things wrong with it, so to speak, and being able to layer in digitization, professionalization, AI, etc., and really grow and build on a strong base. So ETA is really exciting. And as Liz mentioned, I myself have gone down that road after a long career in consulting and in the corporate world and found it very fulfilling. As well as very, very challenging. So it's exciting, but it's not something to be taken lightly if you go down that path.
And
So
you yourself, Grant, sorry, I don't,
yeah,
just for your own background, were you, did you come directly out of corporate and when you bought in 2020, that was your foray into what you're doing now?
I actually have quite a bit of experience on the startup world. I actually started, believe it or not, a call center, a pan-European call center business back in the 90s with a
Oh,
partner.
neat.
And we were supporting all the new telcos that were coming in the wake of telecom deregulation in Europe, as it had happened here with AT&T being broken up, right? So, um, raw startup, raising money from family and friends, growing it and then eventually selling it. And I was involved in a few other startups too. So it was, though, to your question, Liz, my first, foray into actually buying a cash flowing successful business. And I guess maybe part of it was the risk calculus was a little bit different for me at a different stage in my career. I was hoping not to live on, ramen noodles and popcorn again. And not to say that I haven't had to do that, but that was part of it. And also just what's kind of interesting is the more experience you have, and the further you are into your career, the more you have at stake. But by the same token, the more likely you are to succeed, right? So that's kind of what's exciting about jumping in and buying a business. So next slide, if you don't mind, Liz, is just, looking at, again, reality check on what's going to actually sell. So we're just building up to some assumptions around the likely number of businesses and enterprise value that may actually end up changing hands. And so again, if we just look at a conservative 30%, it's about $1.8 million businesses. And if 1.8 million businesses, sorry, and if you assume that $5 trillion is enterprise value is really reasonably accurate, divided by 6 million, you have about 830K per business on average. So the next slide kind of sets up this financing gap, I think. So $1.5 trillion of value and a typical just taking a 10% buyer down, 10% seller note, you've got a third party financing need of about 80% of the purchase price, which is a $1.2 trillion need for financing in some form of another over the course of the next 10 years. So if you divide that by 10, it's about $120 billion, by our estimation, that of acquisition financing that's actually going to be needed. And I think the last or second to the last slide, Liz, if you don't mind, is just looking at, again, the go-to of SBA lending. And again, it's not the only form of finance, obviously, for business transitions. But if you look at, SBA volume has averaged about, for 7A, about 33 billion over the past 3 years. And again, only a portion of the 7A program is used for business transitions. And that's a little bit tough to get at that data. But if we assume it's about 25-30%, you can see the gap here in terms of estimated SBA acquisition lending volume is about 10 to 12 billion annually, and that leaves about $100 billion gap in financing. And
Wow.
so it's something that as we've gotten into it and looked at, it's like I don't think that folks are stepping back maybe nearly as much as they will to realize that wow, we've got a huge gap here. What is going to emerge to fill that gap? And some might argue, well, the SBA will just step up and lend more, and it isn't necessarily that easy. You don't see exponential growth in SBA lending. You see spikes during COVID and other times, but it's tied to congressional mandates and so forth. And as we well know, SBA can be lengthy. There can be very underwriting heavy. And can take a long period of time. And so, in what we're seeing currently is some of the guidelines are becoming more restrictive, not less restrictive. Some of the changes in March 1 guidelines for SBA lending, for example, makes it impossible for you to get an SBA loan unless you're a U.S. citizen. So
Hmm.
there's a number of challenges and constraints on top of the fact that there just isn't nearly enough loan volume here, right? So looking at that gap, of course, in supply and demand and in the market, there are emerging solutions. There are emerging forms of capital and financing to address the gray wave. Jumpstart, in particular, is involved in many of them. And so I'll talk a little bit about kind of what I'm observing, a little bit about what we're doing. This is not a shameless pitch for Jumpstart by any means, but just kind of what we're doing, what we're seeing. And then I would love to have a discussion with the group about whether these things resonate with you, whether you're seeing similar things, or if there are things that we're missing here. But so these are partially observation and partially prediction, I would say. So there's been a lot recently in the headlines around private credit, of course. The sky is falling on private credit apparently. But the important thing to remember with private credit is not a single asset class and it's not a monolith, right? What we're seeing in private credit is largely in the very, very large funds, the publicly traded, the KKRs and the BlackRocks of the world, and also private credit funds, private credit providers that focus very much on the high end, the large corporate clients. And there's been some issues with overexposure in certain sectors. And some of the biggest issues have really been around structure and liquidity. So when you think about a debt instrument, it's essentially an illiquid asset, right? You can't very well, if you're holding a loan, you can't very well say, hey, my investors want their money back, Mr. Borrower, so I'm going to have to ask you to pay off your loan so that I can pay my investors. It doesn't really work that way. It kind of works that way in a secondary market, and there is a very immature secondary market for private credit. Private credit secondaries are just kind of beginning to come on stream, so that's going to free up some of the liquidity and some of the concerns and issues around redemptions that private credit investors have had, and the gating that has stopped them from being able to pull their money out, which of course has led to some mild or maybe more than mild panic. I just wanted to clarify that private credit, when I'm talking about it here, I'm talking
Hmm.
about funds and private lenders that are specifically focused on the kind of the lower mid market, the SMB market, which is really where most of these transactions are happening. And so I'm beginning to see some of these emerge, and I'd love to hear from the group here as well. Non-bank lenders that are specifically focusing on acquisition finance. And that's what we do at Jumpstart. We're a non-bank, essentially a private credit lender. We do have a sponsor, an FDIC regulated sponsor bank, and we do use their balance sheet as well. But it gives us, as other private credit providers, a tremendous amount of flexibility around underwriting and structuring deals. So you're not tied to, the standard operating procedure of the SBA programs. You're really tied to making sure that your investors are getting the returns that they expect, and making sure that the credits and the loans that you're writing are of high quality and are going to perform well. So the advantage of private credit is your business, your deal, the ETA deal, may not have to fit perfectly within typical conventional lending or SBA guidelines. There will probably be more flexibility with regards to private credit, and typically they'll move faster, right? Now, the trade-off with speed and flexibility is often price. And so, you'll find typical private credit funds are going to be a little bit more expensive than, although if you look at it at first year on a first year APR basis, including all closing costs and so forth, at least for Jumpstart, we actually are a little cheaper than SBA, believe it or not. But there's definitely going to be some more flexibility. So I see private credit is really, and part of what we're seeing and reading in the headlines, if you're scrolling around LinkedIn much, you'll read a lot of opinions on private credit. I actually see it as an opportunity for the ETA space, because I think rather than having a very blind pool without a lot of visibility into what's being financed in a private credit vehicle, I think some investors are going to be a little bit more focused on, hey, I really believe in what's happening with ETA. I want to be part of it, and I want to be involved in maybe a smaller fund that has more visibility and has a broader set of um, sort of diversity across the borrower base and doesn't have a high level of concentration, which is the good news about doing a lot of, somewhat smaller loans, right?
Yeah.
Up to the SBA limit. So private
Can you
credit is
talk
one
a
of the
little
things
bit
that.
about, yeah, can you talk a little bit about like the differences that a searcher may experience between looking at private credit and how SBA or traditional lenders would look at a deal? Like what are some of those other differences? Like you mentioned that, it might be a little bit more costly to go with private credit, but what are some of those other differentiating factors?
Yeah, one of the things that I've seen, and I know it's something that we do at Jumpstart, is um, you tend to bet very heavily when you look at an SBA, sort of underwriting approach and philosophy. They tend to look very, very heavily at the business itself, at cash flow, at the historical financials, at the DSCR, the debt service coverage ratios. And looking at where it fits within their risk profile, if they're too concentrated in a particular industry, et cetera. Are they businesses that we can't finance or fund? And then you obviously look at the jockey, right? You look at the person or the individual, the partners that are going to be running this business. But I would say it's a little bit more weighted in private credit, and I'm speaking from our perspective to the jockey, right? It's like who is this management team? Who is the entrepreneur? Because ultimately that's who you're really betting on, right? You're looking in the rearview mirror to look at the performance of the business, but you're also looking at through the windshield to look at the possible growth prospects and the ability for this operator to not just do no harm, but to actually, take the business to another level. So I'd say it's a little bit more of a holistic view of underwriting. And then, the other thing that I think, and if there's anybody that runs a private credit fund or is a private credit lender on the call, I'd love to hear from you as well. But from our perspective, we look really carefully at structure. We want to see a good deal of skin in the game, both from the buyer and from the seller. And so it's not to say that the seller or the buyer needs to bring 30% down, but I know SBA structures are such that there's quite a bit of flexibility. If the seller is willing to go on standby for their note, a buyer can come in with as little as 5% down and have the balance matched with a seller note, for example. Although 10% is pretty much rule of thumb. So we would be looking for a minimum of 10% and preferably more from the buyer just to see skin in the game. And then I
And I
think
know.
the other thing, I'm sorry, Liz, just really, really quickly, the only other thing I would say is that it's not going to typically follow an SBA underwriting process in terms of tons and tons of documentation and many different layers, depending on the size of the SBA lender, many different layers that you need to go through to get to final approval. So it tends to be a little quicker and more agile.
I know that SBA has some parameters around the seller note where if it doesn't meet certain covenants, it needs to be deferred for the full term of the SBA loan. Is that how it works in private credit? Are there, allowances for the seller note to be paid out sooner, or what are some of those parameters that you guys are seeing?
Yeah, and again, I can't speak for everybody in this space, but for us, we factor the seller note in and we include it in all of our cash flow analysis and debt service coverage ratios. We assume it's going to be paid along with, any senior credit or any other loan on the business. And we think that's important because a seller that might have a note that's hanging out there is not going to be as excited about doing a seller note, right? And then B, as sort of engaged in the business and seeing it being paid immediately. So but you're right, like oftentimes that can be an impediment for sellers to carry a note on the business from an SBA perspective is, I don't want this thing to be on standby. I'm going to touch on here as we move forward what I see happening in the seller financing space as well, which I think is pretty interesting and some things that we're doing there. But for sure, For us, again, speaking for ourselves on a seller note, we would expect the business to cash flow and be able to cover both our financing as well as the seller note.
Perfect. Sorry, I realized I jumped ahead there. Go
No,
ahead.
no, it's all good. Anybody else have any questions or input around private credit or anything you're seeing in the market?
We have a quiet group today. They're not
Yeah.
as strong.
Well, and family offices kind of factor into this too. You know, some of them will work with private credit providers. One thing I do want to mention about private credit is like people know what it is, right? Especially now, but some folks don't know how to get a hold of private credit lenders, and one of the reasons for that
Mhm.
is they're not the best at promoting themselves, and they tend to be weak at origination. They tend not to have, like for example, most SBA lenders are amazing marketers, and they're out there on LinkedIn and they're out there at all the broker shows and they're talking about how great their bank is. And many of them are absolutely amazing lenders and amazing resources for entrepreneurs. Private credit tends to sit in the background a little bit in the shadows, and they're very selective about deals. And deal flow just comes from different sources, right? So you do have to hunt and you do have to search and you do have to ask around, I think, and we'd be happy to help with some of this. Um, for folks that are specifically focused on this space. And what you'll find too is you begin to reach out to some private credit funds, and I would include SBIC funds in that mix, which is technically money that's being funneled into small businesses, but through private funds, and there's a pretty healthy matching component to those funds. What you'll find with them is they tend to still focus a little bit higher, kind of more middle market and less on the SMB market. So that's what I see emerging is, private credit being more visible, more, obtainable and identifiable, and I think also moving a little bit more downstream, for one of a better term, just in terms of deal size.
Mhm.
Um,
Yeah.
all
And then
right,
we
should
have,
we move?
yeah,
Sorry,
we've
go.
got one question there in the chat, but I think it ties into your number two here with angel investors and
Yes.
structure. I'll let you carry on there. And
Yeah, so the other thing that we're seeing, and we're kind of spearheading it, is just looking at angel investors as a source of capital for acquisitions, right? So we all know angel investors, maybe some of us are or have been angel investors. The traditional model has obviously been, let's look at a bunch of startups, let's write 50,000, 100, $200,000 checks. Let's know that maybe 9 out of 10 of them are going to fail or are going to struggle, but one of them is really going to hit it. And I'm going to, have a wonderful return of capital experience. And, typically that horizon is 10x over 10 years for a successful angel investor. But what I'm seeing, and this is something that we've launched recently, a firm called Biz Buy Angels, playing off of Biz Buy Sell, of course, is that there are angels who not don't want to abandon their involvement in the startup market. It's exciting, it's a bit of a gamble. They love new tech and new innovative ideas and so forth. But they also are feeling like another asset class that's still involved in investing in businesses and seeing entrepreneurs grow and seeing them build something would be appealing to them. So in Biz by Angels, what we're doing, and I think there's a little bit more. This is some other groups that are doing some similar things to this, so I don't want to claim we're the only ones involved in this. But in terms of what we're doing, is we're saying, look, you know, the gray wave is happening. There's tons and tons of great, successful, established, cash flowing businesses. You love entrepreneurship. You love seeing businesses grow. Put your money into, let angel investing evolve for the new type of entrepreneur. So the model is very similar. It's still an entrepreneur, an operator, or a group of operators, but rather than going out and starting something, they're buying something and building something. So the way that we've structured this is that the angel investment that comes into an ETA opportunity would be primarily a debt instrument, and it would
oh,
be a debt instrument that returns P&I back to the angel over a period of time. So you're basically automatically getting back your your principal, and then there would be, a small equity upside. So the angels are not taking, and we haven't even talked about search funds here, and I'd love to hear
Hmm.
folks' thoughts on how that is evolving as well. But unlike that, you're not giving up a large amount of equity. With the angel, we're trying to get them to about a 20% IRR over a fixed horizon of about 5 years. And so you're going to see that they'll get maybe close 8, 9, 10% on the debt instrument, and then the balance on warrants and some equity as that comes in. So the fixed horizon is around recapitalization or refinance, not necessarily sale of that
Right.
business, right? So there's nobody leaning and breathing down your neck to say, when are you going to get this thing? I want to see hockey stick growth. I want to see it sell. I want to get my money back. So again, in keeping with that angel concept of, we're here to support and here to help you grow. Liz, you
I
had a
have a
question?
question. Yeah, I do on that. Like when we raise capital, like we got familiar with what was called a convertible note. Is that
Mhm.
kind of similar here?
A
Like,
little bit. So, like, yeah, the safe note, that's a very common mechanism amongst angels, which is, for future equity, right? There's that happens all the time. The difference, of course, is that those are typically either early stage, pre-seed, seed, A series startups.
hmm.
What we're actually doing is we're looking at a business, and we're looking at a business and underwriting it just as if we would be funding it ourselves, right? So we're looking at, because you're coming, for example, we're working with an entrepreneur who is buying roofing businesses and is creating a platform and is planning to do some sort of a roll-up strategy, but bringing tech to bear on these roofing businesses that are typically, roofers are kind of running these businesses out of their back pocket or out of their front seat of their truck, right? So bringing a lot of improvement to bear, but going out and pursuing an acquisition roll-up strategy. So what we're doing is saying, yeah, we want to look at this roofing business in Bozeman. It's been around, it cash flows, it's got really strong SDE, and here's the valuation. It's maybe coming through a broker. We feel good about that part of it. Now we need to talk about the operator, what they're going to do, and then we're going to talk, back into the equity portion that needs to be in place for that to happen, which typically would be kind of in the 5 to 10% range. Again, with the entrepreneur being able to buy out the angels within a fixed time horizon and own 100% of the company unless there are other equity partners involved, obviously. So we're looking at it pure. So it's a little bit different.
Hmm.
I'm familiar with like the convertible note concept, but it's actually an originated private credit note that's being serviced, and then the angels are essentially co-investors on that note, right? And we have two
Yeah.
models, and it'll be interesting to see how this evolves over time.
Hmm.
But we have a committed capital model, which is through a fund. So that money is more liquid and available. And then we have the more traditional angel model, which is pitched to a bunch of angels and get them excited. And the ones that are excited have additional meetings and jump on board and start writing checks, right? So we feel that is both are viable, but there's a limited shelf life to a business acquisition, right? It's usually, it's unless it's completely off market. Um, it's usually, there's some competition for it, right? So we feel the
Yeah.
committed capital model is the right way to go with this. So you
Yeah.
had another
Yeah.
question, I think, Liz. Sorry.
Yeah, I do. Well, I think this ties back to, and I hope I'm saying your name correctly, Kioma's question around the ownership structure. So if, through a vehicle like Biz Buy Angel, if it's starting out with debt, then yeah, what does the equity structure look like if the searcher's coming in with 10%, kind of
Yeah.
what's the structure falling, where the ship's
Yeah,
falling?
so we want the searcher and the searcher's partners, whoever else might be involved on an equity, filling an equity gap there. We want them to be 100% owners of the business within 5 years. So the way we're looking at equity is, obviously the longer term 10x in 10 years, the angel horizon that's typical for startups is quite different, right? Because you're putting your money in, you're taking a big gamble, you're putting your money into an idea in many cases, right? Or something that's barely getting any traction or starting to get traction. Although those are heavily vetted opportunities, you're taking a large risk and you expect a large upside over time. So you're going to retain a good equity portion. the entrepreneur may end up with, even a minority stake, right? Whereas here it's the other way around. It's we're looking to get most of our money out of the P&I, out of the debt instrument, right? Because, it's
Mhm.
cash flowing. And then we're looking to give an equity kiss, I guess, one way to describe it, a small equity upside to get the balance of the IRR for the angel. So the idea is to be able to return 100% of this. So whatever the equity structure is coming in, if it's just the entrepreneur or entrepreneur plus a couple of partners, that's the equity structure that will go beyond the buyout of the angel equity piece, if that makes sense.
Yeah, yeah, it does. It does. The other fund models that we've seen is where it starts off with, pref shares, and then when there's been a return of capital with interest, then it converts to common shares. But you guys are saying that you stay as a debt instrument, and then it converts to common.
We would take like penny warrants up front for X% of the business. That would be either owned by individual angels, depending on the model, owned by individual angels through an SPV, or it would be owned by the fund, with us being the fund managers, right? And then we would return that back at refinance or at a recapitalization or sale, if that happens, of the company to our investors. Now there may be an instance where um, the entrepreneur or the team isn't able to buy out the investors, and so in that case we would have, those warrants could, continue for a period of time, or they could be rolled into the financing. We haven't gotten there yet, so we're still early stages and working on our first deals, right? So, but the idea would be to again, like, we're not trying to go toe to toe and compete with and say search funds are bad or they don't work. What
Mhm.
we're saying is you're the ones out there taking the risk. You're the ones growing the business. You deserve to own all of it. We just want to get reasonable returns to our angels within a defined time horizon. It's kind of how we're looking at it.
Yeah, and from the angel investor's perspective, compared to getting nothing for 10 years, this kind of
Exactly.
seems relatively attractive.
Yeah.
Um, Connor had some questions here in the chat as well around covenants, and I just don't want to lose it. But if you want to maybe read the question there and let us know where you want to kind of plug that into the conversation, if you want to come back to it later, that's okay too. But around covenants and how your
Yeah.
model compares.
Yep. 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 I'm just looking at it now. Yeah. So it's a great question. It's one of those things where I can tell you what we do as a private credit lender, and I don't know that this is true for all private credit funds, but our covenants are relatively light. I mean, we've got we have reporting covenants and transparency covenants around taxes and credit scores and P&L and additional debt. We obviously are always going to be in a senior position, to and have to be with, even any existing debt and so forth. But what we don't have are some of the covenants that, unless a business is performing at a certain level from a revenue or profitability or margin perspective, then the terms of the loan may change, right, in favor of the lender. We don't have those kinds of covenants, and from what I've heard, really the covenants in private credit do often, tend to be fairly light, because there's a lot of emphasis placed on cash flow underwriting, and as I mentioned earlier, a lot of emphasis placed on the operator and, the sponsor and their
Mhm.
their ability to be successful. Um, so angel operator partnerships, micro private equity, some different models around search funders. That's one of the things that we're working on and we see emerging. These are hybrid debt equity kinds of structures that we've talked about. The other big thing that I would love folks to input on and thoughts on as well is the idea of seller financing becoming more common in the ETA space, and we've touched on it already. What I've seen is a lot of times the seller note is a little bit of an afterthought, right? So I was working on a deal recently. I do some M&A work outside of the lending work that I do, and there was the need to get around some concerns that the SBA lender had around one of the several leases not matching the term of the loan, right? So I think the lease, they couldn't get an extension beyond 3 or 5 years, and it
Mhm.
needed to be 10 years. Um, and so after going back and forth, rather than a reduction in the price, there was a concept of a forgivable seller note put together and to help move the deal forward. And ultimately, we ended up going a different route with this deal. But the bottom line is like it's oftentimes an afterthought. It's oftentimes a broker convincing the seller that it makes sense for them to go ahead and carry a note because otherwise they're going to lose the deal, or this buyer's really otherwise qualified. And so we need to put, so it means it's a very fragmented, very non-standardized activity in business acquisition, in the business acquisition landscape, I should say. And it what as a result of that, it means that it's a completely illiquid, concept. So most sellers, if they're carrying a note on a business, have explored the idea. I shouldn't say most. Many have explored the idea of trying to sell their note and sort of cash out, right? And being able to say, look, I put the note in place, but it's a 7 year note, or it's a 5 year, or a 10 year note, and there's a balloon. But I think I'm just going to go ahead and sell it because I want to cash out. I need the money. I don't want to wait. I don't want to necessarily take the risk with this buyer not performing, and doing what they need to do. And so they'll go and try, there's a small handful of note buyers that will potentially purchase seller notes. Well, they often run into challenges. The note isn't really quite structured well enough for the secondary market. The rate's too low. There's too big of a balloon. It wasn't properly documented. It isn't being serviced. There's no real service history to show the note's been paid on time. Someone's getting paid through Venmo or something. I'm exaggerating here, but the bottom line is it's not sort of a standardized like a bank loan would be, right? And then
Mhm.
the other thing, a lot of the secondary folks that are buying and looking at notes are going to deeply discount that note because of, the reasons I just mentioned, and because of some of the risk associated with buying a seller note that has been previously originated. So you'll see discounts up 50 plus percent. And then the seller has to say, look, it's just like if you win the lottery, you can take a lot of money now, or you can take even more money over a longer period of time. So they say, I'm just going to take a discount and get my cash and walk away. Where we see a tremendous amount of opportunity is, I was talking to a head of a large brokerage with brokerage all over the country in the U.S. here, who said that like what people don't know is that many deals don't even make it to conventional lenders. They don't even make it to SBA. They just do a seller note. The buyer brings in a bunch of money, the seller carries the balance, and off they go. And so there's this hidden financing market that's happening with seller finance that a lot of people know if you're involved in the deal, but you might not know about it as you look at the overall landscape. What we see as a tremendous opportunity is to create standardization and to make the seller note an actually a liquid asset that can be sold on a secondary note, on a
Yeah.
secondary market, sorry, much in the same way as you would sell a mortgage note or any other kind of note. And we think there's a couple things that need to happen to make that possible. One is that the note has to be originated correctly. It has to be originated in order to sell it, right? So,
Yeah.
just simple things like the right kinds of documents, a proper promissory note. It needs to be originated with the right interest rate that would make a secondary buyer interested in it. Doesn't have to be an outrageous interest rate, but it probably can't be 1 or 2%. Um, and it needs to avoid, large balloons that would cause a buyer of that note to be concerned. So it needs to amortize over a certain length of time. And then we believe that in a partnership that we're working on right now, if those things are in place, that a seller could potentially carry a significant note, knowing and feeling confident that there is a robust and reliable secondary market for that note. And I think that in some ways, obviously the buyer would still need to have equity and skin in the game, There may
Mhm.
even be the capital stack may include some other lending, like a, private credit, a mezzanine tranche or something like that. But then the seller could really carry a fairly significant note on that business, knowing that, hey, after 6 months of seasoning, after the buyer has successfully serviced this note, I can turn around and go to X marketplace, or I can turn around and go to this resource and sell my note, maybe at par or maybe for a slight discount. So I know that some people, in fact, I was reading recently, misrepresent the idea that, hey, if you're an ETA entrepreneur, just go out and buy a business that's cash flowing and just get the seller to carry the whole note. Like, we're not there yet. That's a terrible idea. And I wouldn't recommend that to anybody. However, in the spirit of looking at some emerging trends and what's happening in this financing ecosystem, I personally believe, and partly because we're behind building this right now, that seller financing could just become an absolute viable alternative to traditional conventional lending if structured in the right way, so that the seller actually becomes the bank. And what I like about this is, the business already. You've run it and owned it. You know whether it can support the debt. You now know the buyer, and you have a good sense about whether the buyer or buyers are able to run this business effectively. You've structured it correctly, you've serviced it correctly, and now you know there's a takeout option for you, after holding it for a period of time. So if you got sellers on board that way versus an afterthought, or the broker has to twist their arm into doing a note or whatever, if you got sellers on board earlier on with this concept, I think more and more sellers would jump on board. So
Yeah.
interested in folks' thoughts on that, but I definitely am seeing some potential there as well.
That's really interesting. I've heard in Canada of, at least one private credit provider considering buying out the seller note. However, they were in their model, they were thinking of positioning them buying out the seller note like during negotiation. So instead of the seller coming in and providing the seller note in the first place, that the private credit provider would come in. I guess that would almost be considered the mezzanine approach, but and pay out the seller's portion before the deal even closed. And I was like, I don't know if that's going to work because you're dealing with timing, and then the seller, they don't even have the opportunity to realize the note. But I see what you're saying. It's interesting. I know, I'm a former business broker, and so from my perspective, I was always a big believer. You've got to at least introduce the idea of the seller note and the seller financing when you engage the client to sell their business, because if they find out about it at the final hour when they get their first offer, and sometimes they've never heard of this concept before, like it just blows up the negotiations. But
Yes,
it's interesting what you're saying about, what if it was majority seller financed, and where do you see, wouldn't a seller want, more cash? They want more cash on closing. It's not a matter of would have.
right.
Most of the time,
Yeah,
if there's, if I can get this cash on closing and this is at risk, I'm going to go
yeah.
for I'm going to go for cash on closing. What's your
Everybody, everybody's going to I'll take as much cash as I can get. I'll take 100% cash. But if getting all the cash at closing, um, puts the deal at jeopardy, right? Or if you know that you're 3 or 6 months out, the SBA lender is causing delays and causing deal uncertainty. Time kills deals, as we all know. And Liz, you've seen it before, I'm sure, as a broker. Um, I think the whole thing to me hinges on, and this is like the test marketing we've done and kind of rolled some things out. In fact, probably when we met in Denver, we were sort of piloting the seller note concept, seller bridge, calling it seller
Mhm.
bridge note. So in
Mhm.
other words, the whole thing hinges on, yes, I'm gonna get some cash and a significant amount of cash. I don't think 10% is ever gonna fly in this scenario. So the buyer has got to bring more cash to the table.
Mhm.
The seller has got to have terms, has got to have a high level of confidence that this note is going to be serviced and a lot of protection built in. They have to have a decent enough interest rate where they can see that they're actually making more money doing this, right? And then they have to have a high level of confidence that if they want to, they can sell this note successfully on the secondary market. So that, to your point, that all needs to be happening way pre-closing, right? Like they
Mhm.
need to be even in conversations with a secondary buyer saying, we like this note. Here's how it has to be structured. After it's performed for X number of months, we feel comfortable buying it from you. Like that's the kind of thing that's missing today, right? With it's a more of an afterthought. I'm going to go try and see if I can sell this darn thing because I'm sick of reminding the buyer, I'm sick of waiting around for my cash. So, I think there are a number of like infrastructural, conceptual issues that or blocks that need to be built, if you like, to make this work.
Yeah.
But I think conceptually, and everyone we've talked to, and when we floated it and focus grouped it and so forth, including with secondary partners, by the way, I think everybody can see where this could really fill some of this finance gap,
Mhm.
that we're
Even
facing.
if, yeah, even as from a buyer's perspective, if you're trying to, position the idea of a seller note to the business owner, and you can say, down the road, post closing, you 2 to 3 years in, you can, and even just from a suggestive perspective, suggest that that you can potentially sell this note on the secondary market. Like I would say that's majority entirely new information for them. Um,
Yeah, no, you're right. I don't think people really understand just how much note trading goes on, except when they get a notice from their mortgage company that the note's been sold. But it's really no different, right? I mean, there's all kinds of trading that happens with business notes, and with seller notes. And I do think it's partly just an educational hurdle, Liz. And I also think it's track record, right? Like going and talking to another business owner. Yeah, I did everything that sellernote.com told me to do. And I went, and after 6 months, they looked at all the bank statements and it had been serviced on time, and they made me this offer on it, and I got the cash, and it was great. So that sort of snowball needs to begin to roll down the hill a little bit before I think people get really comfortable carrying large notes. But
yeah,
I'm predicting
interesting.
that it will. I'm predicting that's something that we'll see happening more of.
That's
So.
interesting. And I like Disha's question here in the chat. She's wondering, about the personal guarantees. And I know SBA has some parameters on, investor guarantees. And, if you're on the cap table and you own more than 20%, you have to sign a personal guarantee. How does it work with PGs in the private credit market?
Yeah, we're pretty hardcore on personal guarantees, I'll be honest, and many times because we're lighter on collateral. We don't. I know with SBA, if you've got, what is it, more than 25% free equity in a home or in property, that the SBA has to take that as collateral. I believe that's the rule. Whereas we're much more looking at the business as collateral, the business itself, the cash flow. We do have UCC filings on the business. We like it when there's real estate. We like it when there's equipment or other assets, and that's not always the case, obviously. But on the PG side of things, absolutely, yeah. Anybody with over 20%, I honestly think you're going to find that to be pretty consistent across private credit. That there are PG requirements, so a little bit lighter on the collateral and a little bit heavier on the guarantees.
Any guarantees required from the seller if the seller's coming in with seller financing, or would that only be a situation where they might be rolling some equity and the PG would be required from them as well?
Yeah, no, yeah, no guarantees required from the seller. I mean, that would probably be part of a purchase sale agreement and probably be in the covenants around, you agree to complete training, you agree, to non-solicitation and non-competes and things of that nature. So it'd be really
Mhm,
between
mhm.
buyer and seller versus between seller and lender in this case. So.
Yeah, interesting. And so to your point four here, conventioning lending partnerships, how do all these vehicles play together in
Yes.
the car lot?
Yeah, yeah, good question. So, yeah, these all sort of overlap to some extent, right? Every deal, there's always multiple moving pieces in most deals, right? A lot of complexity, which is why, by the way, I don't ever see business brokers getting cut out of the loop. I mean, I think they're always going to face pressure and competition, but the idea of a for sale by owner, business model. It's not quite as easy as selling a house for people who've done that by themselves. But the fourth point here around partnering and co-investing or co-lending. So we talked about the gap, the $100 billion opportunity here. One of the ways to address a gap, and one of the ways we do it is, if we have any tightening liquidity, we can turn around and take some of our loans and sell them on the secondary market, the same way that a seller would sell their note. And we have secondary market partners. We have a platform that we work with. We have an institutional buyer that we work with. And then we have just individuals that want to buy notes. Like I like the idea of a note. I'm getting 10, 11, 12, 13%, on this note. So the idea here is that, you've got maybe limited liquidity in some places, and maybe there's a fund that wants to come in on, come in on part of a loan and wants to participate with or syndicate with another fund. You're seeing some partnerships between banks and private credit providers. Again, there's an origination and a client sourcing and a deal sourcing engine that a private credit provider might plug into and say, yeah, we like that deal. We'll put 5 million, we'll put 10 million into that, type of thing. So you're going to see more and more of these partnerships. The other thing that we're going to see more of is this idea of secondary market trading of ETA related notes. And, there's a platform that we've done some work with that does participations, right? So it's becoming very much sort of a marketplace where, for example, we might originate, a $10 million loan on an ETA, and rather than tying up all of that $10 million, we might put it out on a participation platform and say, hey, we're offering 5 million of this loan for sale to other private credit funds, family offices, other banks, conventional lenders. And they've done all the due diligence, all the underwriting. It's a great loan. It's all fully documented. Is anybody interested? And then we literally can participate out, as it's called, part of that loan. And bank participations have been going on for decades. It's very common between banks to shift loans around and to free up balance sheet space. But it's becoming more common now in the private credit space, family offices, and even with individual investors. So we see that as another way of, again, getting to that, addressing this gap, not tying up all your capital for, an extended period of time, on, a loan, but maybe participating out part of it post closing, right? Or participating out, syndicating out part of it at closing or pre-closing. So I think you'll see more of those kind of partnerships between even SBA type, conventional lenders and private credit funds, and then between private credit funds and between um, other folks that are involved in this space. So hopefully that I see that we're almost at time, so I'll stop
We
now.
are almost at time. That sounds like a very, very underground market. So I
Yeah,
guess would you say it's valuable for anyone who's shopping their debt and trying to figure out how their capital sources are going to come together to at least have a conversation with you on the private credit market with your team?
we're open to any kind of conversation, any follow-ups. If you've got any questions of around anything we covered today, if you disagree vehemently or otherwise, happy to have a conversation with you. Would love your
Mhm.
perspective. And absolutely no obligation. We're not going to try to sell you on Jumpstart or sell you on the Angel program, but just love to have a conversation. And it's really exciting what's happening in the market right now, and we're getting forced into a situation where we have to be innovative, which is really cool. There's this wave of fintech innovation because banks were so stultified and typically lacking in technology and lacking in really innovative customer solutions. And that's where you saw the Zells and the PayPals of the world and all the
Yeah.
Robin Hoods of the world. And there's similar things I think happening in the ETA space that I've only mentioned a few things here, and I'm sure I've missed a bunch, but I really
Yeah.
appreciate you inviting me here today, Liz, and everybody's time.
No, this is fantastic. Disha's wondering what's the best way to get in touch with you or your group? I'm sure you're busy, but
Absolutely. Yeah,
and
just jumpstartfinance.com, grant at jumpstartfinance.com. I should have put that up on the slide there. Sorry. But yeah, check us out. Happy to set we can set up some time to chat, and I would love to do so.
Fantastic. Thank you for all your insight, Grant. I've got a few nuggets and things that I'm going to certainly keep in mind and keep learning about. So we really appreciate you sharing your insight and yeah, how your space in the private credit market is evolving. It's certainly fascinating right now. It's really exciting times.
Yeah, thank you. Agreed, Liz, and appreciate everybody's time and have a happy rest of the day, Friday, and a great weekend.
All right. Happy Friday, everyone.
Take care, guys.
Take
Bye bye.
care.